Welcome to the Explainer. Today, we're jumping straight into one of the most fundamental and, frankly, most fascinating mysteries of corporate finance, dividends. If you've ever looked at a stock and wondered how those cash payouts actually affect its underlying value, well, you're in the exact right place. We're going to completely demystify the mechanics of dividend valuation, breaking down both the hardcore math and the human psychology behind what makes a company's payout so absolutely crucial to its share price.
So here is the massive question staring every single investor and corporate manager right in the face. Do dividends actually drive stock prices? Think about it. When a company hands out cash, does it inherently make that company more valuable? Or is it really just moving money from the left pocket to the right pocket? This single dilemma has sparked decades of fierce debate among financial theorists, and today we're going to unpack it using the exact same models the pros use. Okay, let's quickly map out our roadmap for today. We'll start with the dividend relevance debate, move into the dividend capitalization approach, break down Walter's and Gordon's valuation models, and finally, we'll wrap the whole thing up with a concept called the bird in hand.
Let's kick things off with Section 1, the dividend relevance debate. For decades, the financial world has literally been split right down the middle on how we should treat these payouts. On one side, we've got the dividend relevance school, championed by heavyweights like James E. Walter and Myron Gordon. They argue that dividends absolutely 100% impact a firm's value in its overall share price. On the flip side, you have the dividend irrelevance theory, famously pushed by Miller and Modigliani. They argue that in a perfect market, the timing and quantum, meaning the specific amount distributed, doesn't affect firm value at all. Now for this explainer, we're going to focus heavily on the relevance side to see exactly why these payouts really do matter to your portfolio.
Moving right along to Section 2, the dividend capitalization approach.
So this approach is the core mathematical foundation the relevant school uses to prove their point. And it really just boils down to calculating the worth of all the future cash flows you'd expect to receive as an investor. The capitalization approach says that a share's value is simply the present value of all expected future dividends. It looks at this infinite stream of constant dividends and then adds the present value of infinite returns generated from whatever earnings the company decides to hold on to. Basically, if you want to know what a stock is worth today, you have to add up the value of every single dollar it's going to pay you from now until eternity, adjusted for the time value of money, of course.
Which brings us to Section 3, Walter's valuation model.
Professor James E. Walter gave us one of our very first major tools to evaluate equity within this whole debate. Now, I know his formula looks a bit intimidating at first glance. There were definitely a few variables and fractions layered in there, but seriously, don't let it scare you off. It's really just a brilliant mathematical representation of that capitalization approach we just talked about, perfectly balancing what gets paid out to you versus what the company keeps to reinvest.
Let's actually translate these variables into plain English so we can see how it works. R is the firm's internal rate of return. That's the percentage a company can earn if they keep their cash and reinvest it in their own projects. K is the cost of capital. You can think of that as the baseline market expectation, like the bare minimum return investors demand. E is earnings per share, and D is dividend per share. By weighing R against K, Walter's model tells us exactly what a company should be doing with its cash.
What's really fascinating here is how this creates a three-firm motif. It proves that optimal payouts shift drastically based on the internal health of the business. So Walter puts companies into three buckets. If you're a growth firm, your internal return R is greater than the market expectation K. Your optimal payout ratio? 0%. You should keep the money. If you're a normal firm where R equals K, the payout is actually irrelevant. Changing it doesn't move the needle on share price. But if you're a declining firm where your internal rate R is less than K, the company is literally destroying value by hoarding cash. Their optimal payout is 100%. They need to give everything back to the investors.
Let's really lock this concept in, because it is the absolute cornerstone of dividend relevance. When a firm's internal returns beat the market, meaning R is greater than K, they must retain the earnings. Why? Because they can compound that cash far better internally than you could if you took the dividend and invested it somewhere else. By keeping the cash, a growth firm maximizes the ultimate market price of your shares.
All right, let's jump to Section 4, Gordon's growth model.
Myron Gordon developed another profoundly influential valuation model using this exact same capitalization approach. But to isolate the effect of dividends, he built his model on a few pretty strict theoretical stepping stones. First, he assumes an all-equity firm with zero debt. Second, no external financing, so expansion only comes from retained earnings. Third, the internal rate of return, R, is perfectly constant. And fourth, the cost of capital, K, is also constant. Now, sure, these assumptions are definitely rigid, but they create a perfect laboratory environment for us to test how dividends interact with stock value.
And here is Gordon's formula. What makes this model so unique is how it explicitly builds upon the retention ratio, denoted by the letter B. That's simply the fraction of earnings the firm plows back into the business instead of paying out to you. When you multiply that retention ratio B by the internal return R, you get G, the growth rate of earnings and dividends. It's a beautifully elegant way to tie the share price today directly to the expected future growth generated by the money the firm chooses not to pay you.
And here is the real kicker. Despite using slightly different mathematical routes and variables, both Walter and Gordon arrive at the exact same conclusion. It's amazing. Growth firms, where R is greater than K, absolutely must retain more earnings to boost the share price. Declining firms, where R is less than K, have to distribute their earnings back to shareholders. The logic is beautifully consistent across both frameworks.
Finally, that brings us to Section 5, the bird in hand.
This is kind of the climax of our explainer. We're going to shift gears from cold hard math to human psychology to explain why, in the real world, investors so deeply crave dividends. A bird in the hand is worth two in the bush. You've definitely heard that proverb, right? Well, what's amazing is that Myron Gordon actually revised his initial model to incorporate this exact piece of ancient wisdom. He realized he had to step away from those perfect market assumptions to deal with actual, messy, human risk and uncertainty.
The whole core hypothesis here relies entirely on our built-in risk aversion. You have to weigh certain present dividends, that's the bird in your hand, against uncertain future capital gains, the two birds in the bush. When a company retains earnings, they're essentially promising you future growth. But let's be real, the future is inherently risky. Investors, just by human nature, prefer the absolute certainty of cash deposited into our brokerage accounts today over some theoretical promise of capital appreciation tomorrow.
Because uncertainty naturally increases with time, those distant future dividends are discounted at much, much higher rates. Simply put, we hate risk. A company offering a steady, predictable source of current income actively reduces our financial anxiety. And because of that, firms with high payout ratios often command a higher value in the market. They attract what's called a high payout clientele, a specific group of investors who value the shares of paying firms more than those that abstain, simply for the peace of mind that regular income provides.
Which leads us to a final provocative question for you to chew on. Are you paying a premium for the bird in your hand? Take a look at your own portfolio. When you buy a high-yield dividend stock, you're very likely paying more for that certainty, trading away potential supernormal growth just for the comfort that tangible cash provides. Understanding this dynamic, balancing the strict math of Walter and Gordon with the very human psychology of the bird-in-hand hypothesis is really what separates average investors from those who truly understand how to value equity. Keep that in mind the next time a company announces its quarterly payout. Thanks so much for joining me on this explainer, and keep learning.